Opportunity zones allow real estate investors to capitalize on huge tax incentives while revitalizing distressed communities. This video will show you exactly how these zones work and how you can use them to maximize your investments. Stay tuned to discover the key strategies for navigating opportunity zones and unlocking their full potential for your real estate portfolio. What are opportunity zones? Opportunity zones are specific areas identified by the IRS as economically distressed communities. These are locations where new investments, when meeting certain conditions, qualify for significant tax benefits. The whole idea of opportunity zones came about in 2017 as part of the Tax Cuts and Jobs Act. The goal was simple: drive economic growth and revitalize areas that need it most by attracting investors. By the end of 2019, about $4.5 billion had already been raised across 365 opportunity funds. That number alone shows just how quickly investors are jumping into this space. But what makes these zones so appealing? It all comes down to the benefits investors can receive. By putting your money into these areas through a qualified opportunity fund, you can defer, reduce, or even eliminate taxes on capital gains. So, not only can your investment grow, but you can also take advantage of those tax incentives. Opportunity zones are designed to boost the economy in places that need it while giving investors a real reason to contribute. Up next, we'll explore exactly how you can benefit from these investments and what it takes to get started. How do opportunity zones work? Opportunity zones work through something called a Qualified Opportunity Fund, or QOF. To get the tax benefits, investors have to put their money into one of these funds, which are specifically set up to invest in opportunity zones. For a fund to qualify, 90% of its assets need to be invested in these designated zones. Now, what makes this even more interesting is that it's not just about real estate. If you've made a profit from selling stocks, a business, or almost any other investment, you can roll those capital gains into a QOF. This allows you to defer paying taxes on those profits for a certain period. So, how does this all work in practice? When you invest in a QOF, the fund can use your money for new development or to significantly improve properties in opportunity zones. This could mean building new projects from the ground up or revitalizing existing properties that are in poor condition. The goal here is to breathe new life into struggling areas while also giving investors a chance to grow their wealth and get some pretty big tax breaks. In short, by investing in a qualified opportunity fund, you're not only investing in potentially profitable projects, but also contributing to the economic growth of these distressed communities. And of course, those tax benefits are a big part of why investors are so excited about opportunity zones. What are the tax benefits of opportunity zones? The tax benefits of opportunity zones are a big part of what makes them so attractive to investors. Let's break it down. 1. Benefit is capital gains tax deferral. When you invest capital gains into a qualified opportunity fund, you can defer paying taxes on those gains. The tax deferral lasts until the investment is sold or exchanged, or until December 31st, 2026, whichever comes first. This means if you have profits from selling stocks, real estate, or a business, you can reinvest those profits into an opportunity zone and push off paying taxes on them for several years. 2. Is step up in basis for long-term investments. Holding your investment in a QOF for 5 years comes with an extra benefit. After 5 years, 10% of your deferred gain is excluded from taxes. For example, if you invest $100,000 in capital gains, after 5 years, only $90,000 of that gain would be taxable. If you hold the investment for 7 years, the exclusion increases to 15%. So, on that same $100,000 gain, you would only be taxed on $85,000. This step up in basis reduces the tax burden significantly, rewarding you for holding the investment longer. 3. Permanent exclusion of capital gains for long-term investors. The most exciting benefit kicks in after holding the investment for at least 10 years. Any gains from the growth of the opportunity zone investment itself are completely tax-free. For instance, If your $100,000 investment grows to $200,000 over 10 years, you wouldn't pay taxes on that additional $100,000 gain at all. This permanent exclusion is what makes opportunity zones a powerful tool for building wealth while minimizing tax liability. What are the requirements for investing in properties in opportunity zones? When investing in opportunity zones, the property itself has to meet certain requirements to qualify for the tax benefits. Let's go over them. 1. Original use or substantial improvement requirement. For a property to qualify, it must either be put to original use or undergo substantial improvements. Original use means the property is being developed from the ground up or has been vacant for at least 3 years before purchase. This could be new construction or rehabilitating a long-abandoned building. If the property doesn't meet the original use criteria, you'll need to make substantial improvements. That means doubling the value of the building within 30 months of buying it. So, if you purchase a property for $10 million and $6 million of that is for the building, you need to invest at least another $6 million to improve it. 2. Brownfield sites. Properties that are classified as brownfields, sites with potential environmental contamination, can also qualify. To meet the criteria, the investor needs to make improvements that ensure the property meets basic health and safety standards. This is another way opportunity zones help in revitalizing distressed areas, turning contaminated sites into safe, usable spaces. Ensuring that your property investment meets these criteria is crucial to gaining the full tax benefits of investing in an opportunity zone. The focus here is on encouraging new development or significant property improvements in areas that need it most. Investing in opportunity zones, community impact, and how to get started. Investing in opportunity zones offers a win-win scenario, benefiting both investors and the communities they support. While investors gain from valuable tax incentives, the broader impact is felt in the revitalization of distressed areas. These investments bring new businesses, infrastructure, housing, and jobs to struggling neighborhoods, helping to reshape entire communities. By improving these areas, opportunity zones encourage long-term economic growth and create better living conditions for residents. Some cities and regions are already seeing significant benefits from opportunity zone investments. For example, areas that were once overlooked are now receiving much-needed capital, leading to new developments, revitalized downtown areas, and a boost in local economies. Investors play a critical role in this transformation, contributing to social and economic progress while growing their own wealth. If you're interested in taking part in this opportunity, there are a few practical steps to consider. First, start by researching opportunity zones using tools like the IRS map of designated zones. This will help you identify which areas are eligible for investment and understand where the most promising opportunities exist. Next, it's important to choose the right qualified opportunity fund. Not all QOFs are created equally, so selecting a fund with a strong track record that aligns with your investment goals is key. Make sure to research thoroughly and look for funds committed to positive community outcomes. Additionally, it's essential to ensure your opportunity zone investment fits within your broader financial goals. While the tax incentives are attractive, the investment itself should align with your overall strategy. Finally, it's highly recommended to consult with a tax advisor and real estate attorney. These professionals can help you navigate the complex regulations surrounding opportunity zones and ensure you're taking full advantage of the tax benefits while staying compliant. By following these steps, you can contribute to meaningful community change while securing long-term financial rewards. What are the risks and some of the considerations? While the tax benefits of opportunity zones are appealing, it's important to understand the risks involved. Investing in economically distressed areas comes with the potential for market downturns or project failures, which can impact the success of your investment. Additionally, opportunity zone investments require a long-term commitment, often up to 10 years, meaning your funds won't be as easily accessible. Investors need to carefully weigh these risks against the tax advantages before committing large amounts of capital. Despite these risks, there are many success stories that demonstrate the positive impact of opportunity zones. For instance, cities like Baltimore in Maryland and Birmingham in Alabama have seen significant revitalization through Opportunity Zone investments. In Baltimore, investors have helped transform vacant properties into thriving business hubs, creating jobs and boosting the local economy. Similarly, Birmingham has experienced a surge in housing developments and infrastructure improvements, directly benefiting residents. These success stories highlight the potential for both financial gain and meaningful community change, offering a balance between the rewards and risks of investing in opportunity zones. So, do you think opportunity zones are the future of real estate investing, or just a temporary trend? Let us know your thoughts in the comments. Don't forget to like, share, and subscribe to stay updated on all things real estate.